Restricted stock units, also known as RSUs, are one of the most common forms of stock-based compensation that employees can receive. In today's video, we are going to break down how restricted stock units work, what the tax implications are, and some financial planning considerations for after the shares have vested. Welcome to Couple Bowl. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. Cheers. All right, so to get started on today's episode, let's talk a little bit about what restricted stock units are. So restricted stock units are a form of compensation that are fairly common amongst higher ranking individuals at publicly traded companies. The way that they work is you are granted a number of units, and typically there's a vesting schedule that's associated with those units. So for simple math, let's say you work for ABC Company, and ABC Company grants you 300 shares of RSUs that vest over a 3-year schedule. What that means is you get 300 shares on paper that you can't do anything with, and if you leave the company, you get nothing for. It's very common, this 3-year vesting that I've explained is the most common way that these shares vest, which basically means over the next 3 years, 1/3 or 100 of those 300 shares becomes yours. And so that's what the vesting is. And so as long as you stay there for a full 3-year period, you get the full 300 shares that you were granted. If you leave after 2 years, for example, you get 200 of the shares, whatever's vested on a yearly basis up until the point that you leave. It's pretty common that if you are an employee that's eligible for these shares, typically you get some sort of grant every year. So a lot of times what we see happening is somebody who has shares that vest a third, and they've been getting those grants for a number of years, they'll have 3 tranches of shares that vest every year. So one tranche from the grant that occurred 3 years ago, one tranche from the grant that occurred 2 years ago, one tranche from the grant that occurred last year, and then they get an unvested grant typically around the same time for the next 3 years. And so typically you have a couple different tranches vesting each year if you've been receiving this compensation for some period of time. And from a tax standpoint, the thing to know is when those shares vest, they count as income for you in that year. So they get taxed at ordinary income tax rates. So just like if you received a bonus or a paycheck for $10,000, if you had $10,000 worth of RSUs that vested, whatever the value of those shares are on the day that the vesting occurs, if that's $10,000, then you'll have $10,000 of income. And typically what happens is some of those shares that vest are withheld, kind of like you would have money withheld from a paycheck to help cover whatever the tax bill associated with the vesting is, so that when tax time comes around, if you had a large amount vest, so it's not uncommon that we'll see people who have 6 or 7 figures worth of vesting occur in 1 year. If they didn't have any money withheld for taxes, there could be a very significant tax bill that will come due that they may or may not be prepared to pay. So to help alleviate that, if you have 100 shares vest, it's not uncommon that maybe 33 of those shares would get withheld for taxes, and the remaining 67 shares is what would actually hit your account that you would have control over from there. And so tax item number 1 to be aware of is when vesting occurs, that ordinary income taxes that we're going to owe on this year's tax return. The other thing to be aware of from a tax perspective is what happens to those shares from there. So if we had shares that vested, we had 100 shares that vested, and let's say the share price was $10 per share, and we had 67 shares after the withholding. So we'll log in, we see 67 shares worth $670 in this example. That 670 is the basis for the stock. And so where the basis is relevant is down the road when we decide to sell the stock. We owe taxes on the difference between the basis and what we sell it for if it's up, or we get a tax loss on the difference between the basis and what we sell it for if it's down. So if we have a $670 basis and we hold the shares for, I don't know, 5 years, 10 years, and that 670 grows to 10,000, for example, and we go to sell it and we've held the shares for longer than a year, we are going to owe long-term capital gains taxes on the $9,330 worth of gains that we had in this situation, which typically that's going to be anywhere from 15% to 23.8%, depending on your income for the year. But that's how the second tax bill is going to be determined. And that's determined the year that you decide to sell the vested stock that you own. Now that we've talked through what restricted units are and the tax implications of them, I want to finish the video by talking through a couple financial planning considerations to be aware of. So the first one that I'll bring up is understanding your vesting schedule and understanding what your unvested units are worth. And the reason I bring this up is a fairly common mistake that we see people who receive this type of compensation make is they may take a job at another company for maybe a slight raise, maybe a good raise, but maybe a slight raise, and they don't consider the value of their unvested stock. And it's not uncommon that somebody could give up 5-6 figures worth of unvested stock, potentially unintentionally, if they were not paying attention to it or thinking about it when they made the decision to change the job. And that's not to say don't change jobs, but as you're doing your evaluation on whether it makes sense, it certainly makes sense to be aware of what you're going to be giving up in the form of unvested stock and potentially unvested 401k match, and just being aware of what that number is before you make a decision that you can't undo. The second planning consideration I'm going to bring up is just understanding concentration risk. And so I'll say with some companies that have run up significantly in value that offer large employer-based stock, it's not uncommon that you receive some stock units. Those stock units vest, you keep them, and that happens for a number of years. And then all of a sudden the stock shoots up 1,000%, and you find that a significant portion of your net worth is consolidated or concentrated in one individual name, which also happens to be the company that you work for and you receive your paycheck from. I'll say it's very easy in that situation to say, I'm just going to let it ride. And you see all of your coworkers continuing to make money as the stock goes up as well. What we would bring up from a risk management standpoint is just the having some intentionality around how concentrated you're willing to be. So I'll say everybody's situation is different. A good rule of thumb is 5% of your net worth, at most 10% of your net worth in any individual name. Once you get beyond that point, you open yourself up to a significant amount of risk if, say, the stock were to decline 50%, which is very possible in any individual name, although it's often not something that we can conceive after we've seen the company do really well for a number of years. And so just having some intentionality around how much stock am I willing to own in proportion to my net worth? And once we eclipse that percentage, having a good game plan for how are we going to reduce our exposure and take the proceeds and diversify into something that is more aligned with our long-term goals and objectives. And so that's going to be the third financial planning point that I'm going to bring up, is understanding the tax implications of selling. And so I'll say it's not uncommon that when you set up or have set up one of these accounts through your employer, the default method that gets set up for your account is what's called the first in, first out, meaning when you go to sell your shares, what the system does is it looks at what are the oldest shares I own and it starts selling there. So if you have um, 50,000 shares of company stock and you decide I'm going to sell 5,000, it's going to look at what are the 5,000 oldest shares that I have, and that's what it's going to sell. And you're going to owe taxes based on the basis of whatever those oldest shares are. The downside of that is commonly, if a stock has done well and gone up over time, those are going to be the shares with the largest gain. And so, uh, the missed opportunity is not paying attention to what are called the lots and selling the lots that are most tax efficient to liquidate in that situation. And so, what the sophisticated way to do is when you go to sell these shares is you can see the lot details, and you can find what are the shares that I can sell that are going to create the smallest tax bill possible. So in that same example, we're looking to sell 5,000 of our 50,000 shares in this example. Instead of selling the oldest, which may be up the most, let's look to see what is up the least, or potentially what is down. If there was a point in time previously where the stock was actually trading at a higher value than it is today, and we can cherry pick the losses or the smallest gainers as a way to reduce our concentration, but also manage the tax bill that's associated with the sale that we are completing. Um, it's pretty common that the shares that just vested are probably pretty close to what they vested for. So that's another kind of low hanging fruit place to look, is if we just had 5,000 shares vest and hit our account and the stock hasn't moved, even though it's short term because it's held for less than a year, if there's no gain, then there's no tax consideration. And we can just go sell those 5,000 shares and we won't owe any taxes if we sold it for the same price that the shares vested for. The other idea that I'll bring up is if you're somebody that's charitably inclined and you have concentrated stock that's up significantly, one way to reduce your exposure and get rid of the oldest stock that's up the most without having to pay a tax bill is taking those shares and gifting them either directly to a charity or gifting them to a donor advised fund, or we refer to them as foundation accounts. And so in that same example we've been using, if you had 5,000 shares that you wanted to gift to charity or gift to your foundation account, you take those, you pick the oldest ones, you gift them to your foundation account. The charity doesn't have to pay any capital gains taxes on the growth of the investment. It can sell it, either use the funds for the charity, or if you've done a foundation account, diversify into something that's more diversified than just one individual stock. You've reduced your exposure and you've met the charitable goal that you had. That is everything that I have for us today. I appreciate you tuning in. If you found this episode helpful, I'd invite you to click the subscribe button down below so you can follow along for more financial planning content. If you have restricted stock units that are vesting or are going to vest in the future, and you have questions about some of the stuff that we talked about today and how it might apply to your situation, feel free to look in the show notes where there's going to be a link to schedule a time to meet with a member of our team who's happy to review your situation and give you some feedback, talk about how we might be able to help. That all said, thanks for joining us today on Cuppable, and I'll wrap us up by reminding you to rebalance until rich.